Okay, so when a massive company like PepsiCo starts to see its sales slow down, Wall Street, it gets a little nervous. But here's the thing. Instead of just looking at their polished, prepared remarks, we're going to go deep. We're diving right into the analyst Q&A session from their latest earnings call, because that's where the real story is. And this is really the million-dollar question, isn't it? How does a giant like this turn the ship around? The answers? Well, they're not hiding in some spreadsheet. They're in the direct, unfiltered answers the CEO gave when he was put on the spot by some of the smartest investors out there. So we've sifted through all that intense back and forth to basically map out PepsiCo's big comeback plan, straight from the source. And the very first thing analysts hammered the CEO on? Volume. Right out of the gate, analysts zeroed in on a simple fact. PepsiCo was selling less stuff. But the CEO, Ramon Laguarta, he was ready for this. He was quick to point out that the story, well, it's a little more complicated than it looks on the surface. So what is the real story here? Well, on the beverage side of the house, if you pull out a water business they got rid of, their volumes were actually up, so that's good news. But the food business, that's where the real drag was coming from. See, they made a strategic choice to cut back on those really deep discounts to help their margins, and yeah, that hit their volume short term. The good news? They're already seeing signs that things are starting to turn around. All right, so with the problem laid out, the conversation naturally shifted to the fix. And it's a classic two-pronged attack. One, you innovate like crazy to get more people buying your products, and two, you cut costs to become a leaner, meaner machine. Let's dig into the exciting part first, the new growth playbook. And listen, we're not talking about just changing the packaging a little bit. The CEO laid out a huge, comprehensive effort to get that top-line growth moving again, starting with some of the most iconic brands in the world. Before they even get to the shiny new stuff, they're going right back to basics. They are staging massive relaunches for 3 of their absolute titans, Lay's, Tostitos, and Gatorade. This is all about re-energizing the very core of their business. But it doesn't stop there. They're also making some really interesting bets on where they think our tastes are headed next. And this is where it gets fascinating. The CEO just dropped this line in the middle of the call, basically signaling a huge strategic bet on a new health trend they think is about to be massive. And that one idea, it's driving a whole wave of new products. Now, this isn't just one bet, it's a whole portfolio of them. It's a full court press on health and wellness. They're still hitting protein hard, expanding their offerings there. They're pushing for clean labels with no artificial anything. Of course, they're adding that fiber the CEO is so excited about, and they're even getting into things like premium oils like avocado oil. I mean, they're really attacking this from every possible angle. But all that cool new innovation, it costs a lot of money. So the next logical question is, how are they going to pay for it all? And that brings us to the second pillar of their whole strategy, a huge, aggressive push to slash costs and become a much more efficient company. The CEO got very specific here. And believe me, they are not messing around. They're actually shutting down their oldest, least efficient factories. They're completely rethinking their warehouse network. And as the labor market starts to stabilize, they're looking to optimize their workforce to get, a bit leaner. Now, this is the classic corporate trap, right? And the analysts jumped all over it. Are you going to cut costs so much that you starve the business of the very money it needs to launch all those cool new products we just talked about? It's an absolutely critical question. And the CEO's answer was a very clear no. Here's the crucial part. This isn't just about saving money to make the bottom line look better. It's about creating a self-funding engine for growth. The savings they get from all this cost cutting, it gets plowed directly back into marketing and innovation, which in theory fuels more growth. It's a plan for a virtuous cycle. Okay, so let's zoom out a bit, because while that strategy sounds pretty solid for North America, the consumer landscape outside of the US is, well, it's incredibly varied and really complex. And this slide just perfectly illustrates the global puzzle they're trying to solve. The CEO gave this rapid-fire tour of the world. Consumers in China are being super careful with their money. The Middle East, it's strong. Brazil is booming. But then you look at Mexico, and it's being impacted by what's happening in the US. It's just a crystal clear reminder that there is no one-size-fits-all solution here. But even with all those regional differences, the CEO did identify 3 huge, unstoppable trends that are basically the same everywhere you look. First, everyone is moving to digital. Second, that global demand for cleaner, simpler ingredients is real. And third, the universal need for value and affordability as people's budgets get squeezed. These three trends are really the foundation of their entire global strategy. So, when you put it all together, the big brand relaunches, the health and wellness innovation, the aggressive cost cutting, the complex global picture, it really paints a picture of a company right in the middle of a massive transformation. And as it turns out, there's one more source of pressure forcing them to move even faster. A well-known activist investment firm, Elliott Management, has bought a stake in the company. Now, that can often mean conflict and drama, but the CEO framed it as a pretty constructive conversation. And why is that? Because they both fundamentally agree on the most important thing. PepsiCo's stock should be worth a lot more. So they're aligned on the need for urgent action to unlock all that value. So the CEO's vision for the future as he laid it out through this whole Q&A, it's really clear. It's about aggressively changing the product lineup to match what we all want to buy. It's about using things like AI and technology to build a more flexible company. It's about finding those unique solutions for each individual market. And maybe most importantly, it's about listening to everybody, including investors, to build a stronger company for the long haul. The plan is incredibly ambitious, the stakes couldn't be higher, and the pressure is coming from absolutely every direction. The board is set, all the pieces are in motion, and now the only real question left is, will all of these big bets be enough to win?